Divergence is one of the most powerful technical analysis trading tools in any market. It could be Forex, stocks, indices, crypto, anything, you name it. But like any other tool, if it finds itself in the wrong hands, it could deliver wrong results. So in this video, I want to explain several very important things about the divergences, and it starts with how to spot it properly. And I will be presenting with MACD and RSI indicator, even though it could be used with other indicators. And I will explain how to do it, how to spot and use divergences in the right way, and mainly what not to do, or what will be considered as a wrong way. So I am Vladimir from Home Trader Club, and ready? Let's begin. So today we will be talking about what is divergence in trading, why does it happen, what's the reason that this technical thing really happens, how to spot divergences correctly, when divergence does and when it does not have much value for you as a trader, and we will see examples for each of the scenarios. A little bit about myself and my experience with divergences before I explain all the technical conditions. So I started my journey long time ago, more than 15 years ago. As everyone else, I did all the possible mistakes in trading until I found myself in a position where I asked myself, how can I make money if I do the same mistakes like other traders do? It's ridiculous to do the same things over and over and anticipate a different result, isn't it? And at that point, I said, okay, I'll start to do my research, and that's what led me to the world of technical divergences. Long story short, after all my experience working for brokers, working for a private hedge fund capital, as internationally certified financial technician, as a full-time trader for over a decade, and as a trading mentor, that's exactly what I want to bring in this video, all my experience. I started with divergences, I did all my mistakes there, and I built and polished, I paved my way all the way to the level where the accuracy level is on the highest level it ever was. And it's not because I'm smarter or anything like that than anyone else, probably even the opposite way. I never was graduated in any university. So I'm a very simple guy, and yet the trading part is all about numbers. Make the numbers work for you, and if you find correct technical conditions with the ability to control the numbers, you get the edge, and that's what traders are missing in their trading journey. So in this video, I want to explain you how you can get to this edge and how can you improve or optimize your usage with a very powerful technical concept. That would be the divergences. Okay, so enough about me. Let's talk about what is divergence in trading. So divergence in general is a discrepancy between the price action of an asset and the indicator, which represent the mathematics behind the price. Okay, every indicator has its own mathematics, its own calculation, and the result is what you see. And when you see this, basically this discrepancy between the price and the indicator, typically in oscillators, that's what is used by majority of traders, you understand that something is happening. Okay, divergence basically gives you sort of indication. It indicates a weakening of a prevailing trend, simply potentially signaling of an upcoming reversal or at least a slowdown for some time. And very important to remember that divergence by itself is a technical term, technical condition, technical analysis concept. It does not, and I repeat, it does not provide exact entry or exit points. Okay, it helps, it indicates, it based on indicators, it indicates a potential trading opportunity to build. And price movement or price action must be combined with divergences. Otherwise, and that's the mistakes that I was doing at the beginning, as I mentioned before, otherwise you will be wasting time. Okay, divergence by itself means not much. Okay, unless it happens in a specific level, which we will be talking today, and get the verification on the price if it happens to be in specific conditions. Okay, so that's about the divergence in trading. So why does divergence happen? Where it comes from? So divergence occurs due to disagreement between the price action and the indicators used. Okay, disagreement, it's maybe a big word, but where the price says one thing, but the indicator indicates something wrong is happening. It's like when you look outside of the windows, oh, that's sunny, but the wind and the gray skies that are coming from some point could be indicating that something is going to change. Okay, so that's the same about divergence. Something shows on the price, and the indicator could actually hint that something is potentially about to change. But the main causes of divergence are shifts in market sentiment and changes in the balance of supply and demand. Think about it this way: when something is launched and the price is good, everybody's buying. So everybody's buying, the price is going high. Simple. Until some point. That point is where the balance between the supply and the demand starts to lose itself. Okay? More people, or traders in our case, are willing to sell than those who are willing to buy. Okay? So the price will always find a way to balance itself, and that's the indication that divergence brings. You will see that on the charts in a few minutes. As buyers and sellers struggle for control, divergence emerge, hinting at a potential shift in the market direction. Okay? So this is why divergence actually happen. Now let's see, how does that look like? Okay, so how do we spot a bullish divergence? So bullish divergence occurs when the price forms lower lows, but the indicator creates higher lows. This suggests that despite the downturn, the momentum of sellers is waning, and buyers might soon gain control. The sellers are losing their grip, losing their control. Traders should watch for potential trend reversal, the upside, when bullish divergence appears. Bullish divergence also classified as positive divergence, as it indicates of potential reversals. Okay, the reason it's called bullish divergence is because if you think about it, in a bullish direction, the market makes higher highs, higher lows. So that's the indication it's about to switch. So this is how it looks like for bullish direction. On the price, you would see lower lows, on the indicator, higher lows. Okay? Exactly as you can see on this very example. This is, by the way, the MACD indicator. And if you are not certain what to do with MACD, I really recommend you watch the video that appears right now on the right top corner of this video. And you can always download, if you don't have this indicator for MT4 or MT5, you can download my MACD indicator, and you can use that with the link below this video. Okay, so as you can see here, the market making lower highs, lower lows, and with a comparison between lower lows, which check on the MACD. I love to use mainly moving averages for the serious reversal or trend changes. In some cases, histogram could be also enough, but the MACD moving averages in combination with MACD histogram and RSI, which we will see in a few minutes, would give you the best calls, or the best odds, I should say. So while the market making the lower lows, indicator make higher lows, as you can see. Okay, you can see lower low, okay, higher lows. Okay, so that's about the bullish divergence. Take a look how a bearish divergence looks like. That will be exactly the opposite. Okay, so bearish divergence, on the other hand, happens when the price creates higher highs, but indicators form lower highs. Okay, that's the contradiction between the two. That indicates that despite the uptrend, the momentum of buyers is weakening, sellers may take charge from here. Traders should be cautious about a possible trend reversal to the downside when bearish divergence comes in play and happens, and when it manifests. So that's how it looks like. Higher highs on the chart, lower highs on the indicator. Take a look. Uptrend, high, low, higher high. Okay, or we can classify that as H1, H2, right? And here the indicator shows the opposite. H1, H2. Okay, classical scenario where we can see that the indication is obvious to the downside here. Okay, same about the histogram in that case. Okay, so this is how we spot a divergence. Now that was on MACD. It could be absolutely the same on the RSI. It could be absolutely the same on momentum indicator, bulls and bears indicator, CCI indicator, force indicator, and you name it. Okay, it's absolutely the same logic, deviation between the indicator, which is the mathematics behind the current price. Different indicators give different mathematics formula, but the deviation or the contradiction here between the price and the indicator is what creates the divergence. Before I continue and explain all the other technical conditions, I would like, first of all, to take the opportunity and to thank you for watching this video. And I would also like to ask your support. If you find value in this video and other videos I upload for you in this channel, please hit this like button. Feel free to share it with anyone who you believe can benefit by watching that. And few words in the comment section would be a great help. As you know, this is how YouTube algorithm works. So in order for this channel to stay relevant and take the content I have here to more audience and help other traders with the specific subjects I'm talking about and with trading knowledge, your help is needed and much appreciated. So thank you in advance to all those of you who take the time and assist and help. Also, if you are new to this channel, welcome to our fantastic community. Please consider to subscribe with the subscribe button below this video. Just remember to enable the notification so you know when there is a new content available for you. Okay, so thanks again both for watching, for helping with the like button, a few words in the comment section, and let me know if what you see today really helps you to understand the divergences better in a different light, in a better light. Okay, let's continue. So here is an example for divergence on MACD and RSI, and you will see some examples here on both. Some examples are on only one. As a rule of thumb, like any other technical condition, that's very important before I move on. When any technical conditions happen to be on several indicators, especially from different world, like MACD and RSI, they both represent different formula, mathematics, and logic. So when a divergence comes in different indicators and on higher time frames, okay, it's not like divergence on lower time frames would not work. It's just that lower time frames are always noisier. So on higher time frames, any technical concept, technical analysis concept, would have more value and reliability. The reason is simple. On higher time frames, there is always bigger money flow. There is much more money going through the market in a 4-hour chart than 15 minutes. And much more money would go through the daily charts as the trends form on daily charts, right, than on 1 hour. It's very simple logic. And due to that, the reliability, the more money is involved in a specific wave, trend, movement, the more reliable it is, because the more reliable highs and lows would be created in these money flows. Okay, very simple. So the idea here of bullish bearish divergence applies to any time frames, but higher are more reliable. It could also be spotted on any of the indicators, but for me, MACD is the first one and the most reliable list, and RSI follows that. Some traders love the opposite direction. First of all, RSI and MACD, absolutely fine. But when it appears on both, on specific levels, which we will see in a few minutes, it gives you the edge I was talking about before. So here is an example. And also very important to remember divergence is deviation between price and indicator. Price must be at the end of a trend to spot a divergence, positive or negative divergence, basic divergence, which means there has to be a sequence of highs and lows in a given direction, or a trend in a given direction before divergence was spotted. So in that case, let's start from the beginning. As you can see, lower highs, lower lows, and then between these two spots, L1, L2, and here L1, L2, okay? We get lower lows on the chart, higher lows on the indicator. RSI as well, even though it looks like it's flat, it's slightly higher, okay? It gets us a bounce to the upside. Then another low, L3. Now we have divergence between, okay, here we got L1, L2. Now we have divergence between L2 to L3 and also L1 to L3, okay? Beautiful divergence. Keep in mind the sequence, lower highs, lower lows. You cannot do something like that. Okay, whoop, and then say between these lows there is divergence. You can't. It has to be sequence. Okay, a classical trending conditions. Very, very, very important thing to remember here. Okay, and then we can see how the market reacts, much bigger than after L2. Okay, then the reaction to the upside, making sequence of higher highs, higher lows, H1, H2 for comparison. Okay, higher highs on the chart, lower highs on MACD moving averages, as well as the histogram, not RSI though. We can see RSI making higher highs. Okay, in that case, it was only moving average divergence and histogram, but without RSI. We got the market reacting to the downside. Okay, then sequence of lower highs, lower lows, comparison between the lows, L1, L2, higher lows on the moving averages, not histogram, but yes, RSI. Then the market makes the reversal signs and makes the move up. Okay, and so on and so on. But you can see on each condition here, the most important thing is the trending structure. It comes at the end of a trend. Okay, end of sequence. Lower highs, lower lows, then higher highs, higher lows, then lower highs, lower lows. Very, very, very important. So this is an example, so you can see how it's spotted and looks like on both MACD and RSI. Not always it would be at the same time, but when it does happen at the same time on different indicators, especially that represent different math and formula, the reliability is bigger. Now, I prefer to use default settings on my indicators, but for RSI, the only thing I changed here, basically, instead of 70-30, I'll have to work with more extreme levels for oversold, overbought, and made it 80-20. It doesn't mean that's the only way, it's just my preferences. So let's move on to talk about when divergence has the most value and when divergence has the least value. Before I move on, big shout out and thanks to Mugan Markets for supporting myself, my channel, and my team. And you can learn all about Mugan Markets broker in the link below this video in the description, including you will find there the information how you can get your access absolutely free to any of my projects and my products, indicators, trading systems, courses, my trading club, thanks to Mugan Markets partnership. So find it in the link below this video in the description. If you have any questions, don't hesitate to contact us. We will be more than happy to help. So the most value when it comes to divergence, you will find when it happens on a key trading zone. What is a key trading zone? Support, resistance, supply, demand, falling trend line, key Fibonacci levels, and so on and so on. But when it happens with just out of nowhere, which we will see in the examples, it will mean no value for you. Okay, so here is an example. This is the daily chart of EuroCAD. As you can see, obvious uptrend, sequence higher highs, higher lows. Okay, take a look that there is an amazing divergence here, the market making higher highs versus lower highs on the moving averages, histogram, and RSI. Okay, even before there was a divergence here, which created a move down, but it was not significant. Okay, and I want to pay attention why specifically from here. As I said, if it happens to be on a key level, especially if it comes from higher time frame, it will have a great value. And then when you check the higher time frame, make sure you do not have signs against, which means oppose the divergence against. So let's take a look. This is a daily chart. Okay, we are talking here about the end of April, beginning of May. Take a look how the weekly chart looks like. Look at that. It's absolutely amazing. First of all, it went here above the falling resistance line and bounces back. Okay, it has here a classic look at the spikes and the high. Amazing supply area, an amazing broken support that becomes a resistance. Absolutely fantastic level. This is also 1.5, which is a psychological round number. Okay, and moreover, the weekly chart here also falls in the same category. Higher highs on the chart, lower highs on the indicator, also the RSI, also the histogram. So it is absolutely clean that the weekly supports the daily divergence we spotted before by the key zone divergence, okay, and by hitting and rejecting a clean supply area, which is in that case also a resistance. Okay, now take a look when a least value, and that's maybe one of the most important lessons which I want to talk about here in this video. One of the most important things. That's something that traders don't pay attention to, and I want to give you this valuable input. Okay, so let's talk about that. So divergence has the least value when it forms not on a key level, okay, and does have opposite signs on higher time frame. So this is a 4-hour chart. Take a look, okay? Bullish divergence. We cannot argue with that. Clean sequence, lower highs, lower lows. But where it happens? This is a broken support. Now it's a resistance, but there is nothing besides that on this time frame. Maybe on higher time frame, which we will check. But this is already a suspicious area. And if we go to the higher time frame, we will see that this happens to be right here. Okay, but look what happens on the daily chart. The most recent divergence on daily chart is against the 4-hour chart without a key important level, which is all the way here. Okay, so at this moment, the trend changes. It makes lower lows on the chart. It doesn't hold the lows. Okay, and the key level here never managed to reach yet. So bearish divergence or negative divergence on the daily chart hints for a sell. Lower lows on the daily chart hints for a sell. Most recent trend line breaks hint for a sell. And the 4-hour chart shows buy. That's exactly what you will want to avoid. When higher time frame is obviously clearly against you, your odds would be lower. It doesn't mean that the 4-hour chart divergence cannot deliver. It means the odds would be against you. So the chances it will deliver a significant move that will allow you to benefit and profit from it would be much, much smaller. Okay? Now let's talk about the next condition. When it happens to be not on a key level. Take a look here, CAD-yen, 1-hour chart, clean sequence, lower highs, lower lows, obviously clean. All right? And higher lows on the MACD moving averages as well as the RSI. Beautiful bullish divergence. But let's take a look on this vertical line. Okay, as you can see, 11th of July. Take a look. Where are we? In the middle of nowhere. That's higher time frame, right? I love the levels from higher time frame. We're in the middle of absolutely nowhere. How can we do anything here? We can't. That's the bottom line. The key levels, broken resistance that now becomes a support, broken resistances here that become a support. And this is a demand area here. Okay? And that's the 105, by the way, also round number here around this area. Okay? So we are here at the middle of nowhere. Therefore, the lower time frame divergence we saw will have no value. And the chances that it will deliver would be significantly lower. These two things, if you will implement them in your trading and you will pay attention to them, you would see how everything you do with divergences will start to look differently and will deliver much, much higher accuracy in your trading. These two things are the things that separate those who really do react to significant levels, price, and indication in combination, or those who just say, oh, there is divergence, let's trade. Oh, there is moving average cross, let's trade. Oh, there is support. Oh, there is resistance. One factor would never be enough to make a decision. Combination of factors will. That's trading, increasing your odds and your probabilities. So thank you very much for watching, and I really hope you found value in this video. And if you did and you still didn't do that, please hit this like button. Few words of support in the comment section would be a great help and very much appreciated, of course. And thank you very much in advance. And I would like to invite you to join our trading family, Home Trader Club, where you will get your access, full access to our full trading courses, real-time trading education, real-time trading opportunities, our community, myself, and so much more. So join us with the link below this video in the description. And once again, big thanks to your time, to you for your time. And I wish you and yours all the very best and successful trading. I'll see you soon with more content and more education. All the best. And once again, thanks for your time. Bye for now.